Good morning, everyone. I hope you're all doing very, very well. So I suppose today is obviously Friday, last video of the week and last day of the week, trading day of the week. But we do also have non-farm payrolls today in the US. So for those who are new and following along, non-farm payrolls is the monthly payrolls figure that comes out of the States, first Friday of every month. And it takes into consideration all the key metrics associated with how the labor market is effectively performing over the last 4 weeks or a month. Now, when we look at the, I suppose the payroll figures as a whole, should I say, it's not just a case of looking at the non-farm payrolls and seeing, well, is it higher, is it lower than previous expectations or consensus, and then being able to buy or sell off of that. There is additional piece of information we do have to take into consideration. So, for example, here, now I'm using two economic calendars just so kind of people can visualize it as well. So I suppose from that perspective, there's 3 or 4 pieces of data that I kind of focus on primarily. When it comes to NFP, when it comes to being able to, I suppose, interpret the data from an economical perspective, I look at kind of all of these different pieces of data as a collective rather than individually, and obviously trying to make some sort of conscientious decision off the back of that. So if we just take this economic calendar just for a moment, firstly, obviously, most importantly is the jobs numbers. Okay, so previous figures is coming in around about 315,000. The consensus for this month is 250,000. So we know that the ballpark range is going to be somewhere between kind of 250 to 300. Okay. Now, of course, if we have a massive miss and we're kind of sitting at 150 or maybe marginally underneath, that's obviously going to be negative. Okay. Anything above kind of 320 is going to be bullish. But at the same time, the Fed are going to have to be taking that into consideration because, of course, if it's a case, the non-farm payrolls were, let's say, 350,000, in the eyes of the Fed, they're going to see that as very, very positive. Okay, they're going to see additional creation other than what's expected, and that's going to give them a little bit more leeway in terms of when it comes to the next interest rate decision. So the big data point every month or every 6 weeks is, of course, the interest rate meetings. So they look at the CPI figures, they look at growth, and they look at employment. And the mandate of the Fed in the US is specifically towards full employment and stable prices. Now, the stable prices element is what they're trying to tackle now by increasing the rates. But when you look at the full employment element, if these figures are remaining fairly positive, that gives them a little bit more control, a little bit more, I suppose, purpose to, I suppose, continue their current policy. And the current policy at the moment is, of course, increasing those interest rates to a point where it starts to see kind of a substantial impact on those ultra high inflation levels that was kind of seen for the last kind of 6 to 9 months or so. So it's just all about kind of taking that into consideration, being able to, I suppose, understand, I suppose, the mechanics associated with this data, but also the importance and relevant kind of when we go back to the Fed, when we look at all of the kind of the Fed's mandates, and I suppose all of these other pieces of economic data in the month. Now, in addition to the non-farm payroll, the secondary figure we kind of look at is the unemployment rate. So specifically speaking, the unemployment rate has ticked up marginally. Last month, I think it went from like 3.5, 3.6 to 3.7. So there's a marginal tick up there. I think that's probably more a seasonality issue because obviously summertime, you tend to get a lot of short-term employment, and by September, October, that kind of dwindles back down. So that's, I think 3.7 is probably fair price market for where the unemployment rate is now. Of course, similarly, you're expecting that to come in around 3.7. If that goes to 3.9, 4%, the Fed are going to have to look at that as well. So even though the jobs numbers is remaining quite strong, or broadly strong, if it's a case we see maybe this coming in less than expected and this coming in higher than expected, that's maybe a case of, well, we're starting to see less job creation. We're starting to see the unemployment rate tick up naturally. And that's alluding to what Fed Chair Powell said in the last central bank meeting. So one of his big comments in the last central bank meeting was in the sense that he's expecting the unemployment rate to drift up to kind of somewhere between kind of 4.5%. I think he quoted 4.4%. So that's the expectation that comes with having higher interest rates, because higher interest rates means a cut in I suppose the general economic growth. Cutting economic growth means tighter, I suppose, constraints by businesses. Tighter constraints by businesses leads to potential job losses. So I suppose we have to be able to, I suppose, ring fence everything, all of this piece of economics together. So at least that way, then you can see, well, today, if these data prints are higher or lower, how does that play in the broader scheme of things, in the broader kind of aspects of the financial market? So it's important to look at that as well. Now, the last kind of sets of data is one, obviously the labor participation rate. The labor participation rate is the population of the economy which is in full employment. So normally speaking, the participation rate is normally around about 62 to kind of 65% in broad-based economies. Obviously, you have to factor in those who are under 16 or 17 who aren't working. You also have to factor those who are obviously in residential care, albeit whether they're young, medium, or old. And you also have to look at those who are retired. So if you're retired, that's obviously going to factor into the economy. So if you've got a larger population of older individuals, obviously your labor participation rate is going to be lower as a result. So 62 to 65% is kind of the barometer. Sometimes it can drop as low as 60%. So at this moment in time, 62.4 was the previous, again 62.2. So if you're seeing a drop in the labor participation rate, you're seeing a drop in the NFP, in the non-farm payrolls, and you're seeing a marginal tick up in unemployment, that could be seen as a negative. Why? Because the participation rate of the overall economy is down, the job creation of new jobs is down, and the unemployment rate is marginally up. So that would be seen as a negative. So it's important to see how these different metrics, when you put them together, actually create a bias, create an influence in the markets, and then obviously being able to, I suppose, rationalize clearly beyond that. The last piece of economic data is the average hourly earnings, and this is effectively what's called wage inflation. So we've seen obviously the wage inflation tick up quite a bit over the last kind of 6 months or so, in line with broad-based inflation. So obviously companies trying to pay their employees more so they stay, and obviously make sure that they continue doing the job that they're currently doing. So 5.2 is the previous. We obviously, with the inflation figure coming back down over the last kind of 2 prints or so marginally, that would probably mean that the wage inflation is now probably closer to a peak. And if it's closer to a peak, you're probably going to start to see this coming back down to kind of normalized levels. So that's, I suppose, what you tend to expect. So obviously, if the inflation figures are starting to drift back lower, then you'd expect the wage inflation figures to do so, as kind of a consequence, an indirect consequence. And then, of course, we've got the monthly figures of the average hourly earnings as well at 0.3. So that's obviously the monthly kind of inflation on a month-to-month basis as well. So I suppose it's just important to be able to put all of this in, I suppose, a simplified expression, so you can obviously understand the data from our perspective, but then being able to apply kind of a clear logic with that as well. So similarly, like a lot of these economic calendars will have very, very similar data. So for example, if we look at the ACG economic calendar, you can see there very, very quickly the labor participation rate 62.4, 62.2. So coming in pretty much identical. The average hourly earnings or wage inflation is obviously very, very similar. Same too with the monthly figures. So then on the non-farm payrolls, exactly the same. 315 was the previous, 250 is the consensus. And of course, then when we look at the last piece of information here is the unemployment rate, which is here. So they're obviously seeing now this is the broad-based unemployment rate. So I think again, I would trust, I don't necessarily, with this piece of data, there's obviously a few extra pieces of information that's taken into consideration as to why this is 5.4 and the other one's 3.7. But I suppose from a broad-based perspective, the natural unemployment rate should be under 4%, 3.7. If when you factor in maybe certain additions or conditions with that, then you can start to say, well, the inflation rate should be X, Y, and Z because of that. So I suppose it just depends on what the criteria is in terms of the calculation of that metric. But broad-based natural inflation rate should always be kind of under 4%, and that's always been kind of the Fed's mandate. 4% inflation target, 4% unemployment rate is kind of where they've always kind of recognized to see, well, anything below it is obviously a good thing. If we're marginally higher, that obviously means there's a little bit of work to do. When you look at COVID, we obviously went 6, 8, 9%, and they're obviously kind of clawing that back as well. All right. So it's just kind of being aware of that. I suppose when we look at the broader markets today, we're seeing a lot of chop still. The DXY has continued to pick up yesterday. We talked about it in yesterday's video, just be kind of wary of that. The DXY has come all the way back up into these 112s level. We've seen the 10-year yields obviously continue picking up as well. If I just show you that chart, we've gone through the 7s into now the 3.85. So that's ticking up marginally overnight. So that's probably not a good sign for the likes of the indices, the stock markets, because obviously if this starts to pick up again, that's going to add increased pressure into the indices, into the stock markets, into risk-orientated assets. So the likes of your Your FX pairs against the dollar is not going to do that well. Your stock markets, so the likes of your main composites of indices, is not going to do that well. Your probably broad base of stock performance is not going to do that well. And even your cryptos will probably suffer as well for those who actually trade cryptos as well. So it's just being kind of aware of the risk orientation, the risk element. Now, euro dollar has sold off from this parity level at 1. And it's interesting how we got that three-way flag all the way back up into this area here, parity. That was obviously the big talking point on Tuesday. Wednesday, Thursday, we have seen that kind of continued sell-off back into these kind of 97s, 98. So I suppose it just really determines, are we going to close the week flat from what was a very, very bullish Monday, Tuesday? We talked about the potential for a midweek reversal, and it looks like that is obviously the midweek reversal playing out. So I suppose today, just be kind of mindful of that. If you haven't made massive returns until Friday, I would be kind of cautious to say the Friday NFP is probably not the day to kind of make a massive amount of money. So I would just be kind of conscious of your risk. You do tend to get a lot of chop and volatility in the NFPs, particularly the gold prices, the gold markets, dollar yen. There's some of these asset classes do move quite quickly off the back of the NFP figures. So just be kind of wary of that as well. If you are trading, sorry, I was just checking to see if my mic was on. If you are trading that as well in terms of the dynamics at play today. So euro dollar is down, has kind of found a short-term bottom. The cable price, GBP USD, has kind of found a short-term bottom at 111.50. So it'll be interesting to see, is there kind of a short-term rally, let's say maybe 112.50, 113, create that lower high scenario, and then maybe look to fade it then into the close. So I suppose it all comes down into conditions, into your trading plan, what time frames you look at, what's your I suppose entry confirmation structures that you tend to look for within your strategy, and then try and being consistent and wholehearted with that as well. Now, gold, we've seen obviously this area here around 1710s has been quite volatile yesterday. Broad-based price action, this area here at 1720s that I looked at kind of Monday and Tuesday has proved to be a very, very important level. Obviously, we've come up, we've tried to break through it, we've rejected, we've come back in for a second double tap of mitigation in terms of the order block area. Very, very clear rejection from 1723.24, and we've kind of come back into these 1710s. So I suppose today the catalyst would be, if gold is going to take lower, then obviously the stronger dollar play out. You're going to be looking for a move off the back of the NFP, and obviously looking to see obviously these lows being broken to obviously allow further downside. So that obviously would mean that broad base, you'd be looking for a stronger dollar, you'd be looking at maybe negativity, and then being able to kind of rationalize that accordingly. Now, S&Ps has come back into the Wednesday lows. So Wednesday evening lows here that we saw around 37.20, 25 is currently being tested at the minute. If we look at the NASDAQ as well, just uploading these charts very, very quickly. So that's the S&Ps. The NASDAQ as well hasn't quite made it to kind of Wednesday's lows. It has kind of flagged back down into this region. So I suppose your barometer today for the indices is Wednesday evening lows. Okay, Wednesday afternoon, Wednesday evening lows. So kind of around 11.3 on NASDAQ. 37.20, 25 on the S&Ps. On Dow Jones, we've actually broken through. So you can see here how the Dow Jones has actually been a laggard in comparison to the other two, because it is now trading underneath that price point. So just be kind of mindful of that today. In terms of the NFP, in terms of the rationality, in terms of the structure, the actual results. Now, the figures will be at 130 today. So if you are looking to trade that from an arbitrage point of view, or APT, I suppose what you'd obviously want to be looking at is very closely the data. So that obviously comes out at 130. So it will be live on Bloomberg. It tends to be live on Bloomberg every month. You can also get it on TweetDeck, Live Squawk, any of those other companies that kind of do it as well. So you can kind of get that information very, very quickly as well. All right. So last but not least, then is the European indices. So just UK and the UK and obviously Europe. So obviously the DAX in Germany did temporarily get back above that 12.5s, but you can see the last couple of days we've slid back underneath that 12.5 level. We talked about it Monday, we talked about it Tuesday. Kind of watch this level very, very closely. Stop hunt through the price action level, and then of course we've seen the markets roll over. Now structurally yesterday, something I did notice was we kind of had that top formation. We then had the break back underneath 12.5. We had the rejection at 12.5, and since then the markets, albeit not at a rapid degree, however, to a kind of a lesser degree, has kind of ground lower back into the kind of the 12.4s. So from that perspective, it's just a case of, does the markets continue sliding off today? Now, When we look at the FTSE, similar scenario with the FTSE at 7,000. We talked about that 7,000 level earlier the week. So we obviously had a lot of consolidation. We had that pop through it. Price actions now trading marginally underneath. So you'll be looking to see, can we get a clear break back above 7,000 to let the bulls in the short-term sentiment assume control again. But at this moment in time, a lot of price action, a lot of chop and volatility around that 7,000 level as well. All right, so that's pretty much it for today, guys and ladies. And for those who are following, we will be back on Monday for a new week. But of course, today, for those who are trading NFPs, just be conscious of the volatility, trade safe, and of course, everyone have a great weekend. All right, speak to you all next week.